The recording. So we'll get started recording. This is March 18th, 2022 with the Champaign Blockchain Meetup group. We have Andrew Gordon here to talk about cryptocurrency taxes and regulations. So thank you for joining us again, Andrew, and we're excited to hear about what you have for us today.
Well, thank you very much for having me. Would you mind allowing me to share my screen?
Oh, absolutely. I'm very sorry I haven't done that yet. I am making you a co-host right now.
Okay. All right, hopefully you can see the presentation. So hello, everyone. Andrew Gordon. I'll go through a quick introduction in just a minute, but for those of you live in person and those watching the recording, I just want to quickly go through the topics that we're going to discuss today. But as I mentioned before, feel free to interrupt me. I guess raise your hand through Zoom or however you want to scream out, I don't care. And I'm happy to address any questions you have. But I'm going to start with just talking about who needs to report crypto for tax purposes and why, and then about how crypto taxes work, how to actually report step by step, and also end with some tax saving tips. It is the middle of March, and so the tax deadline for individuals is about a month away, April 18th this year. So we don't have that much time, but hopefully for everyone watching that this has some information that you could put into effect within the next month. So first, a little bit about me. I'm an attorney, also a CPA. I actually went to U of I for undergrad and also my master's degree in accounting. So it was about 10 years ago when I graduated from U of I from the accounting department. And I'm sure it has changed substantially since. I'd been back a few years ago, but I haven't been there since. And every time I came by, Champaign was always much different than the last time. So I'll have to come out sometime soon. But from a work perspective, I've been in crypto since 2014. I started my law firm in 2012, and we shortly thereafter got introduced to cryptocurrency. The way we did was our main focus as a firm was on taxes. And really all things tax, from tax planning and tax issues to controversies and audits and even criminal investigations. So all things tax. And then back in 2014, someone came to us and said, I'm getting paid from a foundation in Switzerland called the Ethereum Foundation, and they're paying me magic internet money. And he was actually one of the co-founders of Ethereum, and they were getting compensated with Ethereum early on, and he needed help with figuring out how to report that on his tax return. And so that was one of our initial introductions into the crypto space back in 2014. Since then, we've been very active. We help hundreds of clients a year report crypto on their taxes, generate gain loss reports, and also tax planning as well, identify ways to minimize taxes for their crypto transactions. So yeah, I think I just hit on that. We also do tax debts. And so if you're watching this presentation and you're hearing all about the taxable events that apply to crypto, and you're thinking to yourself, oh shoot, I have a massive tax debt, but you are very concerned on how you're going to pay it, we can also help you with payment arrangements with the IRS too. So all those types of things are services we provide. So who needs to report crypto and why? You're a US citizen, a US resident, a green card holder, generally defined as a US person. You're obligated to report your income on a worldwide basis, which is often a question that comes up. Do I have to report my foreign activity? And the answer is yes. As a US person, you've got to report everything. Doesn't matter where it happened, doesn't matter where you are. If you're a US person, you've got to report it all. And it's more important than ever, especially in 2021, to report your crypto activity. We're no longer in the times of, well, the IRS doesn't know how to treat crypto. It's a Wild West, it's a gray area. Those things at best maybe applied 7 years ago. But nowadays, the IRS is very on top of crypto. It's, in fact, arguably their number one enforcement priority. And to support that, the Department of Treasury has committed some very expensive real estate on the tax return to this exact issue, cryptocurrency reporting. And so if you look on the screen, this is the page 1 of the 1040 form for 2021, but it's very similar to the form in 2020 also. And the IRS asks now, right here, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? Yes or no. Those are your options, yes or no. It's not, I don't know, it's not, I'm not sure, it's yes or no. You have to check a box. And so that just goes to show just how important crypto is in the eyes of the IRS, that after your name and address, the next question is, did you have crypto activity? Even before your standard deduction. So one of the reasons the IRS is asking this is to, one, alert taxpayers that, hey, crypto is something that actually is relevant to tax reporting, but also potentially a less positive intention, which is that if you check the box no, and you in fact had crypto, they're setting you up for a potential fraud penalty or a willfulness penalty, that you said no when you in fact did have the crypto. The IRS did something very similar with foreign bank account reporting about 10 years ago. So we really see them doing the same thing, that they're putting everyone on notice. And then if you aren't reporting, or even worse, checking the box no, that you can be looking at severe penalties.
Andrew?
Yep.
I have a question on that statement. Does moving crypto from your own wallet back to your own wallet to a different key, is that constitute, sure. It does?
No, it doesn't. So, and I'll go through the different types of taxable events. And the general rule of thumb is pretty much anything you do with crypto is a taxable event, except self-transfer. So if you're moving crypto from one of your exchanges or wallets to another, that's generally not a taxable event. The way to think of it is, if you're moving cash from one bank account to another, you're not disposing of that cash or having a taxable event, you're just moving it. That said, you often have gas fees when you move crypto from one to another, or Ethereum based, I should say, often have gas fees. And that gas fee is typically a taxable event. It's a spend. So, just the same as if you were buying a cup of coffee, you're buying the movement of your crypto from one wallet to another. So that is a spend transaction, but the actual movement is not.
What if I just, when I was, trying to get used to this, I transferred like, I don't know, 1/100th of a Bitcoin to my son, and then he sent it back to me. It was just we were testing. This was a few years ago. Does that still constitute as a, as a movement, a reportable thing?
So let me see if, well, we'll get to it in a little bit, but the answer is what you've described. Sounds like a loan. It was a very short loan. There was no interest paid, but it's not a taxable event. You temporarily loaned him the crypto, he paid it back to you. So when you actually do your tax reporting, however, that's where often it becomes more complex, and people come to services like us because you'll see, or the software, if you use software, and we'll talk about software that we suggest, they'll see a withdrawal. And typically the software will either ask, is that a self-transfer? Is that a spend? What is that? And then similarly, they'll see a deposit when it comes back. And is that income? Was that a buy? What was that? And so someone needs to show the software that, hey, these two items are linked, that this was a loan, this was the withdrawal of the loan, this is the deposit. Neither of these are taxable events. They cancel each other out as long as the amount is the same, and nothing needs to be done with the withdrawal and the deposit. Does that answer your question?
So does that mean I still have to check the box as a yes? It's a wash. What's the?
So I guess I would defer to your accountant who's preparing your return, but the literal reading is receive, sell, exchange, or otherwise dispose. Last year, it had the word send. It no longer has that. You didn't receive, you didn't sell, you didn't exchange, and you didn't dispose. but I don't know what other activity you have.
I didn't have
So-
any other activity.
Okay,
Just
so
testing it.
a very literal reading, it doesn't say loans, it doesn't say sending. It used to say send.
Okay.
It doesn't say holding.
Right, it doesn't say holding, and that's actually a good point. Thanks for bringing that up. If you're just holding crypto, and actually the IRS issued an FAQ to address this. If you're only holding, you bought, you're just holding, you don't have to check the box yes, you check the box no.
Okay.
All right, so crypto reporting for tax purposes, it's always been the law. This isn't something new that came in 2020. It's been the law. In fact, IRS defined crypto as property back in 2014. So it's been quite a while that the IRS has crypto on its radar and treating it really the same. And if you don't report properly, not to scare everyone out there, but just things to be aware of, at the most basic level, it's a 25% understatement penalty. But if you're have a very large amount that you didn't report, or you check the box no, then they may assess a 75% fraud penalty to any underpayment of tax. And things can get worse, criminal penalties. I used to do presentations and say, there's going to be a criminal crypto case in the coming years. And just because it's been a hot area of enforcement and the IRS wanted to make it public. I used to say it's going to happen. Well, it's happened. In 2021, the beginning of the year, there was a crypto criminal case. And then actually our client, John McAfee, was indicted on criminal crypto charges. Unfortunately, we weren't able to see that case go to trial. But the IRS now is levying criminal charges on individuals for not reporting crypto on their tax returns. How will the IRS find out? It's a question I'm often asked. It's a question that accountants, tax professionals, attorneys hate answering because the answer should be, you need to report either way, but hey, let's jump in and try to find out how the IRS will find out. So first of all, almost all US exchanges and some foreign are reporting information to the IRS. Coinbase, Kraken, Gemini, even Poloniex, all sharing information with the IRS. They've all been ordered even by courts to turn over information. Poloniex was a foreign exchange, was acquired by Circle, and now they're under the IRS's crosshairs. So these exchanges are basically reporting everything to the IRS, turning over all sorts of information. Coinbase has historically been issuing 1099 forms, and some other exchanges have been as well. Under the infrastructure bill that passed, the exchanges are going to be required to report basically all activity to the IRS and to taxpayers starting in 2023. So more and more reporting, but at this point, I would expect all exchanges in the US are reporting, and in fact, some foreign, Poloniex, which we mentioned, Bittrex, I think in 2018, entered into an information sharing agreement. And a shocker, and this is probably going to be news to everyone. It was news to me. We've got a client currently under IRS audit related to crypto, and the IRS agent has informed us they've been able to get information from Binance, not Binance US, but Binance Foreign. And for years, people always say, well, you know, CZ is never going to turn over information. Binance is always going to be outside. Well, things are changing. And from what we are hearing, Binance is turning over information. So keep that in mind. The IRS can also issue warrants, John Doe subpoenas for specific information, which we've seen them doing and being very successful. And also, just as part of a normal IRS audit, perhaps you forgot to report a 1099 on your tax return and you're flagged for audit. As part of that, now the examiners are informed to ask about crypto as just part of a standard audit. And then once a taxpayer has crypto as part of their returns and they're being audited, the IRS actually has a separate department that just deals with crypto. There's subject matter experts, and they will help the field auditor with the crypto portions of your tax return. And then also tracing income into your bank accounts. Clients always say, well, I'm using only decentralized exchanges, or I don't use any US exchanges. There is almost always an on-ramp or off-ramp that is identifiable. And so it is easy to trace even the work we do, we can trace it. It's very easy to go from, for instance, a bank account to Coinbase to then Binance. And so we had clients that only reported, for instance, Coinbase, didn't report their Binance activity, then got audited. And it doesn't take an expert in blockchain to be able to review Coinbase activity and see that there were transfers to Binance. So it's very easy for the IRS to identify this type of activity. Crypto has been #1 priority, and also the IRS has been on a war path towards crypto. They've issued guidance sporadically, but much more in recent years. First in 2014, then 2017, then 2019, several pieces of guidance, and then 2020, 2019, 2020, an FAQ with, I think, about 40 questions and answers. So a lot of guidance coming out of the IRS, although there are many topics that we're still hoping for more guidance on. The IRS generally has provided enough information to answer most questions, or so that a practitioner, given a certain set of facts, can apply it to the general rules and figure out how most things are taxed. So it's really not the Wild West. An informed tax professional should be able to identify most tax treatment for crypto transactions. Increased audits, which I talked about. Warning letters, it was 2019, I think, when the IRS sent about 10,000 warning letters out to people. And since then, we've been seeing more and more that the IRS is sending what's called CP 2000 notices. And these are basically bills. The IRS is, instead of just auditing people that they think have crypto, they use the information they have and they send a bill. And these bills are massive. And this isn't a good thing. People hear this and like, oh shit, let the IRS do my crypto reporting. It's not a good thing. They basically will establish zero cost basis. Any sale you have is 100% gains. We had a client that got a bill, a CP 2000 notice for about $700,000. When we completed their crypto reconciliation, their tax bill was $3,000. So not something you want the IRS to do for you. And then finally, the crypto question that we talked about on the tax return. So they are making it front and center. So a little bit about how crypto taxes work. Yep, question?
Yeah, real quick. So I know that, you know, people might have been doing this for years and they're trying to get in things in order. If they have to go back and look at things, how far does the IRS go back with audits for looking at these sorts of things?
Sure. So the IRS's standard statute for audit is 3 years. So they go back 3 years from either the later of the date of filing or the deadline. And so typically 3 years, but they can extend it to 6 if there is a gross understatement of tax. What is a gross understatement? 25% understatement of tax. They could go back 6 years. Most of our crypto clients, they're understating way more than 25%. They're going back and amending. So in many cases, the IRS can go back 6 years. If the IRS argues that there's fraud, there is no statute. They can go back unlimited. They typically don't go back more than like 10, but they technically could. So the most common is 3. 6 is also a number, though, that should be on your radar.
Good to know.
So how is crypto taxed? Well, IRS in 2014 defined crypto as property and not currency. So it follows the property rules. So the same things that apply to real property generally, that apply to stocks and other securities, or even just hard assets. These are all considered property under the tax code. And so they're taxed much the same way. So what are taxable transactions? Clearly selling for fiat, selling for another token, or exchanging one token for another. That is a taxable event. It's a disposition or a sale. If you spend crypto, you buy a cup of coffee, you pay gas fees to move between wallets, you buy a computer on newegg.com. All of these are taxable events, even if you don't have cash. People used to buy Lamborghinis with Bitcoin during one of the bull runs. And so doesn't matter if you don't have cash as a result, still a taxable event, and it's treated as if you sold it at the fair market value at the time that you spent it or converted it for something else. So you spend Bitcoin to buy a Lamborghini, and that Lamborghini is worth $400,000. You just sold that Bitcoin for $400,000, and you need to calculate the tax as a result. Staking rewards, Coinbase Earn, mining, all of these types of things. If you're earning additional crypto, that is taxable as well. And being paid, if you're a contractor, you're an employee. We have clients now who are paying their employees in crypto. That is taxable to the recipient, also potentially a disposition or a sale because it's spending for the individual who's paying. There's different tax rates, and the taxes are a little bit different if it's a capital gain event versus income. So mining, typically income, being paid, typically income. That is taxed a little bit different than if you are selling or exchanging. When you sell or exchange, you have a capital gain or a capital loss, and that's depending on the price when you bought it versus the price when you sold it. When you receive mining rewards, staking rewards, that's income to you at the fair market value as soon as you receive it. So yesterday there was an ApeCoin airdrop, or I guess you could claim your ApeCoins if you had a Bored Ape or a Mutant Ape. And so if you claim those tokens, that is income to you. And so a lot of people yesterday, I had a client that posted on social media, hey, I've got $1 million of ApeCoin. And I messaged him and I said, first of all, be aware that that's income and that's taxable. And second, you should probably not put that on social media, because either other people might make you a target, or perhaps even the IRS is going to see, oh shit, you got $1 million of taxable income that needs to be reported. But that's income to you. So hopefully that's not a shocker to everyone that's listening. So the capital gains or capital losses, and I should mention that as well, capital losses and breaking even if you broke even, you still got to report. Gains, losses, no gains at all reported on Form 8949. And this includes all of these different events, conversions, trading, purchases, all of it report on 8949. But income is reported on several different places. It could be Schedule 1, could be Schedule B, it could be Schedule C, depending on the type of income and also how your tax practitioner decides how to treat it. So generally Form 8949 for dispositions, and then one of the income forms or schedules if it's income. There are some things that are non-taxable and therefore non-reportable. And I should mention there's a difference between being reportable versus actually having tax owed. So I mentioned before, you still got to report losses, you still got to report breaking even. Doesn't mean there's a tax owed, but you still need to report it. And one of the important reasons why is the IRS doesn't know it's a loss. They don't know it's a break even. You've got to connect those dots for them. And if you don't, they may send you a massive bill. So just as important, if not more important, to report losses and breaking even. But some items are non-taxable. Giving gifts, not taxable. Transferring between wallets, holding, loans, also another example. But one thing to be aware of for gifts is that if you give a gift over a certain threshold, and I actually think it just increased to 16,000, that you have to file a gift tax form, and that's in the aggregate per year per person that you're giving gifts to. So just keep that in mind as well. So some exchanges are sending these 1099 forms. Coinbase sending 1099 miscellaneous. We've seen BlockFi sending 1099Bs. Before Coinbase was sending 1099Ks. These forms do not help you prepare your taxes. Really what they're doing is they're alerting the IRS that you've got a bunch of crypto activity, but they don't provide enough information in nearly all cases to report on your return. You still got to use software or use a professional because they're only giving part of the information or part of the story. So to report on your tax return, first of all, check yes to the crypto question on page 1, and then use 8949 to calculate the capital gains and losses. And income, again, reported on the other items. I'm sorry, on the other schedules. But for 8949, The different items that we're going to report is first a description of the property. So if you're selling one Bitcoin, or list one Bitcoin. You don't list the exchanges. That comes up often. Clients ask if we have to list the exchanges. You don't. You don't have to show where it is. You just have to show the property. So one Bitcoin. Then the date acquired. Then the date sold. The proceeds or sales price. And then the cost or basis. And then finally the gain or loss. And this has to be done for every single disposition. So if you're selling a fraction of Bitcoin every day, or every couple of days doing different trades, each one needs to be listed as a separate line item. If it's less than 1 year, it's a short-term gain. If it's more than 1 year, it's a long-term gain. And that's very important because the tax rates are very different for long-term versus short-term. Short-term is your ordinary tax rate, which is all dependent on your income levels. It varies from 0 to 37%. And then your long-term rates are less, typically about half, 0, 15, or 20% under current law. So it's a great tax strategy to hold for at least a year before selling. But it's not investment advice. You've got to weigh your own decisions and whether or not it makes sense to hold for at least a year. Software makes this a lot easier because if you recall on this Form 8949, there's all this information you got to report. Date acquired, date sold, being one of the more difficult items to identify, especially if you're buying and selling over time. Now, if you only hold one Bitcoin and then you sell it, this is easy. But if you're buying over time, doing dollar cost averaging, exchanging, moving around, it's very hard to trace all of the gains and losses. So there's two software platforms that we use the most, Bitcoin.tax and ZenLedger.io. They're both do-it-yourself type tools where you can connect your exchanges, upload your data, and then go through and generate the reports. But I would caution you that they are very much tools and they don't necessarily complete it all properly for you. You have to participate in the process. There's a lot of transactions that perhaps won't be identified properly. The software cannot tell if a withdrawal is a spend or a gift or a loan. You've got to identify that. And so that's often something that we help our clients with, especially that have many, many transactions, is identifying all the different taxable events and what is or is not taxable. Ultimately, all the totals are added up on the bottom of the Form 8949, and then they go on to Schedule D. So 8949 is where they're all listed, and then they go on to Schedule D to be summarized. And then if you have income, mining, staking, rewards, airdrops, payments, all these types of things, typically Schedule 1, which is on the right, or it could be Schedule B if it's interest, or Schedule C for businesses. Staking in some situations is a business. In some situations, it's more akin to investment interest. So it really depends. Advise if you're staking or you're operating a node and you've got a lot of that activity, talk to a tax advisor about how best to treat it. It is reported in USD at the time of receipt, the fair market value at the time of receipt. So even if you don't sell it, even if the price drops down, it is still fair market value at the time of receipt. And income is taxed at your normal income rate. So whatever your income rate is, that's what will apply to your crypto income as well. Although the addition of the income may increase now your tax bracket. So just be aware of that as well. So I'm often asked, well, if I've got to pay tax on my income, aren't I going to be double taxed later when I sell it? These are both certainly reportable events. They've got to go on your tax returns when you receive the income and then later when you sell it. But when you receive income, that also establishes your cost basis in those tokens. So say you get paid 1 Ethereum today for developing a website, and that Ethereum is worth $2,500. You have income of $2,500, but then the cost basis of that 1 ETH is also $2,500. So then later when you sell it, say in a month you sell it for $3,000, it's only a $500 gain. The difference between $2,500 and then the $3,000 sale price. So when should you get started reporting crypto? ASAP, at least a month before the tax deadline. Crypto reporting, especially if you have a lot of activities, it's very time consuming. In general, it takes us typically in the order of months to complete crypto reconciliations for our clients. And that's often because there's a lot of data, there could be missing data, there needs to be more data obtained, back and forth in identifying withdrawals and deposits. So it's a time-consuming process, especially if you've got a lot of activity. So get started as soon as possible. Extensions, typically the deadline is April 15th. April 15th is a holiday this year, so it's April 18th. But file an extension, but keep in mind an extension is an extension to file. It's not an extension to pay. You should still make a payment with your extension to avoid any penalties or interest. And then if you file an extension, the extended deadline for individuals is October 15th. Again, that's not the date to pay, that's just the date to file your return. If this is your first time reporting, if you've never reported crypto before, perhaps you even had crypto earlier years and you're hearing all of this and you're thinking, oh shoot, I had a bunch of activity that need to be reported. It's not too late. In fact, I'd encourage you to get ahead of it, retain us or a firm to help you report and amend your prior years. As we talked about at length in the beginning, the IRS is on a warpath against crypto. And you don't want to be in a situation where they're auditing you or giving you a bill or assessing penalties. Much better to be proactive, fix these years, and then file amendments if necessary, if you have prior years. Clients often say, or people often say, well, if I go back and amend and report crypto, aren't I just raising a red flag and putting a target on my chest? In fact, what we've seen is just the opposite. We file hundreds of crypto returns every year. To date, none of our clients that have reported their crypto have been audited related to crypto activity. I am sure this will change, just as I used to say that there would be a criminal tax indictment and that happened. I'm sure our clients will be audited just as a function of the numbers. But what we've seen is reporting thoroughly does not increase audit risk. In fact, seems to decrease it. The IRS has little desire to comb through data and try to figure out if we calculated everything to the penny versus going after the people that they clearly can tell didn't report properly. So strongly encourage you, get ahead of the situation if you think that you had reporting in earlier years to do. So just to finalize, and hopefully then leave plenty of time for questions. Some tax saving tips: hold for at least a year. The tax rate for long-term is much less than short-term. Long-term 0 to 20%, short-term 37% at the high end. So by holding for longer than a year, you cut your tax rate sometimes in about half. Donating crypto, specifically appreciated crypto. If you're holding crypto that's gone up in value and you want to donate, if you donate to a registered 501c3 charity, you can often get a deduction for the fair market value of the crypto, not what you paid for it, but you get a deduction for the fair market value at the time you donate it without incurring a gain to actually have to sell it for cash. But you got to find a charity that'll actually accept crypto. But if you can do that, then that is for many people a great strategy. Report losses. If you had losses in prior years, didn't report, again, losses just as important to report as gains. Losses carry forward year over year. And so even if you don't use them in a certain year, they can benefit future years as well. For those of you that have very active trading, that you're day traders, it's what you do for a living, consider trader tax status. It allows certain things like a mark-to-market election, also allows you to take deductions, take home office rent, equipment deductions, things like that, that generally investors can't take. And there is a distinction between a crypto investor versus a crypto trader. Although we may all use the words interchangeably, from a tax perspective, there is a difference. And then finally, planning is crucial. Keep track of your holdings throughout the year. One of the best strategies is tax loss harvesting, which is selling crypto that you're holding at a loss. And then you can even buy it back under current tax law, which may be subject to change. But by harvesting losses, you can then use those losses to offset other gains. But the only way that you'll know if you have losses is if you've got an up-to-date accounting of your holdings. But it's not just a matter of knowing what your portfolio is, because you may have bought crypto over the course of years, and maybe some of that crypto has higher cost basis than other crypto. And so having an accurate accounting of what you're actually holding, the different lots, and if you're using FIFO or first in, first out, what the actual cost basis of your oldest crypto is, not what the cost basis is overall. I think that's all I have in terms of topic areas, but thank you all for watching, and I encourage you all to follow me on social media. We put out a ton of good information, free information. We put out a video or 2 videos yesterday about the ApeCoin release, so we're constantly trying to stay up to date. So please follow us on social media, and I guess I will open it up to questions.
All right, well, thank you so much. I guess to start, I can ask a question I had from someone who wasn't able to be here today, but said they were going to watch the recording. They wanted to know, this goes along with the ApeCoins as well, how are like token values determined for things like airdrops and NFTs, where they're the first being minted coming to market, where they don't have like a floor price yet in any sort of exchange, you're getting them airdropped to you.
Sure. So the IRS would say you've got to report it as income to fair market value as soon as you have dominion and control, is what the legal terms are. Now, how do you determine what that fair market value is? In some cases, like ApeCoin, there was still is a very clear market and price. Even if you claimed it immediately, it was live on DEXs pretty much immediately, had a fair market value. And so we'll look to tools like CoinMarketCap and pull the spot price, almost to the second where possible, when our clients receive those airdrops, those rewards. NFTs make things a little bit hazier, because NFTs often they're unique, or you've got to look at a floor price. Again, the guidance would say there's got to be a fair market value, come up with some sort of value. And typically we're able to identify a floor or some sort of input to determine that price. I would advise to report something as income, not zero. Zero is a very easy number for the IRS to dispute. Whereas if you put forth some argument in terms of price, that's at least you have a position out there for the IRS to dispute that's not zero.
Okay. So that would be for, even if it's like a project being founded and the founders are getting the coins, they wouldn't want to say zero. They would need to come up with something.
Yeah, exactly. And especially in the case of tokens for founders, because we see all the time that in the beginning, for instance, token founders enter into a smart contract that their tokens vest over the course of years. And then the token project goes live. And then those tokens are worth tons of money. And then they start cursing because we tell them, hey, every time those tokens vest, you've got income at the fair market value. And they say, well, I created these tokens. What nonsense is that? And so in those cases, with some planning, usually what you try to do is establish the fair market value in the earliest days, and you do an 83B election to pay taxes on that early value. But the short answer and general answer is that yes, even founders need to establish a fair market value for their tokens. And if we take this question out of the crypto world and just go into the startup and equity world, this has been happening for a long time. People start businesses, they have shares or equity, and maybe they have contracts, or they give employees equity. And so startups have to value their equity. And there are many companies out there that do exactly that, which is value startup equity, and now even companies that value tokens for that purpose.
Cool. All right. Anybody in the audience have a question?
If you have, an IRA, you can do as much trading as you want and not keep any records?
So in an IRA, typically it's tax deferred. And however, can you do any trading you want and not keep records? That I don't know. I would defer to an IRA administrator. What I could tell you is that we have clients that are trading within IRAs that we still do the calculations and record keeping for. From what I understand is you still have obligations to do the calculations, even if it doesn't have a tax event. You still need to keep track of those things. But I'm uncertain. I would defer to whoever's administering the IRA as to what record keeping and tracking they need.
How about a Roth IRA? Would that be more likely not to, because it comes out tax-free, so why would you need records?
Well, again, I'm not sure of what the legal requirements for managing an IRA and because you're self-custodying your assets. I don't know what those requirements generally are. For instance, if you had stocks in an IRA, someone's still calculating all of the different information for you and giving you a report and keeping track of all that. So I'm not sure.
I remember there was a case where a married couple who were staking Tezos were up against the IRS in a court case, and there was a offer for a settlement that they deferred. Do you have any information on that case and whether that could change the way that staking rewards for proof of stake protocols might change or might not change?
So yeah, we've been following this case very closely. And so there were a lot of misleading headlines when a couple weeks ago when that case was approaching settlement, or seemed to be potentially, that, hey, there might be new precedent that staking is not taxed. That's clickbait at best, fake news, whatever you want to call it. It's just bullshit, actually. It wasn't true. What happened in that case, that there's a $3,000 case that the couple, with the backing of the Proof of Stake Alliance and some attorneys that wanted to make names for themselves, filed a suit for a refund, but it's a $3,000 case. And so the IRS, when evaluating the hazards of litigation, the potential that they may make precedent here, and that the facts weren't all that great to try to actually bring this case to a trial, they said, screw it, we're going to write them the check for $3,000. That doesn't mean the IRS lost. That doesn't mean there's precedent. That doesn't mean that the next individual who tries to do the same on $100,000 or $1 million or even $10,000 is going to have the same result. But the IRS weighed the different hazards and said, you know what, we'll write the check. It's going to cost our attorneys a lot more in time, money, and all these other risks. So from a precedential value, not much. That said, we as a firm have many staking clients, and we're advising them to continue to report the income, the staking as income, to potentially file a lawsuit just as the Jarretts did for a refund, but to evaluate that on a case-by-case basis, because the Jarretts is $3,000. It wasn't about money. It was about Proof of Stake Alliance and some attorneys wanting to have a precedent established. And so litigation is expensive and generally always settles, and often for not the dollar amount that you expect. So on a case-by-case basis, we're evaluating with our clients what makes sense to do. But general advice, don't change anything as a result of this case. Still report the income. I was on a Twitter live with another attorney who was saying, no, don't report the income. And if you get audited, then you could deal with it then. And we respectfully disagree with that position, because if you don't report it, then you're putting yourself in the position to get penalties, at lowest an understatement, potentially a fraud, potentially even more in terms of criminal charges, especially if you have a large dollar amount of staking rewards. And we've got clients that have 7 figures plus in staking rewards. And if you were going to not report that much on your tax return, you are really going into the bad areas in terms of risk. Much safer to report and then lodge a claim for a refund, dispute the assessment with the IRS.
Yeah, that's thank you for breaking that down. I've really been interested in the case because it seems to very much be a gray area in the law where the IRS has made some assumptions that people like the Proof of Stake Alliance disagree with. And the question is, do you want to be the person who could get audited if the law is determined to be in the IRS's favor, or would you rather play it safe and make sure that you follow the IRS's rules until it's cleared up? So it's definitely your risk level is going to play into how you approach that case.
Yeah, absolutely.
Okay. I guess another question is, have you heard anything on the kind of legislations being proposed about adding some sort of a crypto limit for a safe haven for how much you can spend without triggering capital gains? I know that foreign currencies have that sort of thing. I think $600 was the level up that's been mentioned.
Yeah, so some countries have what's referred to as a de minimis law, where transactions under a certain dollar amount don't need to be reported. Germany, I think, is one of the biggest countries that have that with respect to crypto. There have been efforts in Congress over the years to have something like that in the U.S. I don't expect it to happen. We've been moving, if anything, towards additional reporting, not less. In fact, in the last year now, PayPal, eBay, all of those types of sites are reporting basically anything over $600 that's received by individuals. So reporting has been increasing over time. So it's possible in the future that such a law would be passed, but if I was to wager, I don't see it happening.
Okay.
I had a quick question for you, Andrew.
Sure thing.
Thanks for joining us today, by the way. This has been some great information.
Yeah.
You and I have recently traded some emails, and I've engaged you guys to get my crypto house in order. But for the sake of kind of everybody, I do have a question I don't think you and I talked about before. So on Coinbase, and I've been in since 2017, and basically didn't think I had anything to report, and learned on your last video you did with us that I did. So, you know, I'm in a position now of just kind of getting everything together and going forward. But one of the things that is kind of concerning to me is, I'm sure you're probably familiar with on Coinbase, they've got the little educational things. You answer some questions, they give you a few whatever.
Yep.
So apparently I've done it for several of them, but I don't know, a year or two ago, I got something called DAI, and I didn't know it was basically staked, and they're giving it to me every day. Which I guess is fine, but my question is for you, how do you know, when you're going to go back through all of my stuff, what's the easiest way for me to gather up what is a daily transaction over a year or two, you know, to be able to provide you with that information? Or is that, we haven't gone too far down this road. I haven't gotten any information on how to proceed yet, but how do we go about gathering that kind of information when it to me seems overwhelming and vast?
Sure. So typically two ways. We'll either ask you to download the transaction reports from Coinbase, and Coinbase actually makes it fairly easy to download that data. Or the second way would be that with the software, we can use an API key, read-only API key, and then we can pull that data out of Coinbase. It sounds like your concern is, well, it's going to be a lot of data. It's going to be, even if it's every day, a deposit, it's a lot of data. Candidly, Coinbase is the easiest exchange for us to parse data through. Our systems will be able to pull spot price on that. First of all, DAI, I think, is a stable coin. I think it might be to $1. But we'll be able to pull spot price. We'll be able to add up those daily rewards. Not an issue, especially with a centralized exchange like Coinbase, where that data is easy to obtain. We do have some clients that, for instance, run Ethereum nodes, or I'm sorry, ETH2 staking nodes, receive rewards every 6 minutes. Now we're talking a lot of data. Now we're talking a lot of spot prices. We have clients that we have one client that runs 100 nodes every 6 minutes.
Wow.
A lot of data. In those cases, there are sometimes things that we can do to consolidate it, but overall, Coinbase we'll be able to pull spot prices every day without problem.
The only other exchange I use is Uphold. Do you find it to be as easy as Coinbase?
Not as easy as Coinbase, but certainly one that we are very familiar with and is quite common.
Cool.
Yeah, but the general answer though to your question would be that if there is staking, there are rewards, there's anything like that, the rule, what the IRS would expect is that we actually pull the spot price at the date and time of when that reward was received. Sometimes clients say, well, can I just use a daily average or a monthly average or the low for the day? No, the IRS guidance would say the actual spot price. And for everyone listening, I'm sure you're all very familiar that crypto prices fluctuate significantly during the day. Maybe not for DAI, but for other tokens. And so even using a daily average could be extremely misleading. So we try to be as accurate as possible.
Yeah, it's interesting. For the year or two I've been getting this, its value is all the way up to $6 now. So
Oh, wow.
Flood you with information for $6, but
Oh, gotcha. That's the total. Yeah. Well, I should say in some cases like that, where if it's 1,000 transactions for $6, we would probably bill more than $6 of time, candidly. In some of those situations, we'll just tell you, hey, like, let's overestimate $10 and just plug $10 and move on from there.
Okay, thank you.
Yeah.
Hey, go ahead.
Okay, I have a say. You say you have to cover like a 3 to 6 years transaction history, right? But what if there's some exchange? As far as I know, some exchange 1 year or 2 years transaction history you can just export. But what about the missing year? You just don't have the history. So how can you just? You don't know.
How do you reconcile that?
Yeah.
Sure. So I'll answer that question. I'll expand on it a bit too. So some exchanges, I think like Binance, for instance, you can only download 2 years or so, and they just make it hard to get the data. That said, it's generally possible. So there's two series or two categories. There's the exchanges that are just closed and we can't get information from, and I'll talk about that next. But then exchanges that are open that just make it more difficult. The Binances, the KuCoins, those of the world, data's there, they just don't make it easy. We've had clients that have had a lot of success, almost universal success in filing support tickets with these different exchanges and requesting the earlier years data. They know that tax reporting is becoming more and more a hot topic. You're not the only one making these requests. Sometimes it takes filing a couple support requests. Sometimes it takes even messaging them on Twitter. But we've had clients be very successful in obtaining older data from open exchanges specifically. Then there are exchanges that are closed and we just can't get the data, or they've been hacked, or the data's lost, whatever it may be. And it's just impossible. And that's the other category of exchanges. Just can't get it, impossible. For those, we will do our best to reconstruct that data, and we often can get pretty close. We may not know all of the trades that occur in a given exchange that we're missing data for, but we can typically identify withdrawals out of your other wallets to that exchange, and then perhaps deposits, because we have the benefit of time. We're now years beyond when those events have happened. If there were any withdrawals out of those exchanges into wallets, we should be able to see that. So we see the outs, we see the ins. So we should be able to determine what happened in between or what was lost in between. See a bunch of transfers of 5 Bitcoin to Mt. Gox, or pick your closed exchange. And then we see deposits of 1 Bitcoin. Well, perhaps there are some trades or some things that happened, but there had to be a loss or something left there that had to be lost. So often by identifying the ins and the outs, we can figure out what happened in between.
One question was asked about protocols that are doing like faucets. Like you have a faucet and you're pulling some meme coin from a faucet and you're getting random amounts, and there's no USD value that's on the meme coin, but it's giving you amounts from the faucet. How do you guys have a reconciliation method for that?
Yeah, so that's a tough one. And that's in general, the tax code is always playing catch up. Every year we're looking into these new crypto transactions and things that clients are doing, trying to figure out what in the world is this? How is this taxed? What should this be treated as? And this is just another new area too that we're evaluating. But typically, if you're receiving something of value, a new token, even if it's a joke, it has some value. We pick it up as income, report something, try to find a floor price, try to find the first trading price, find something to take a position for the fair market value.
Yeah, cool. And I guess one last question I have, and then we can just sort of wrap it up because I think we're running out of time here. But in terms of DeFi protocols, let's say I have some Ethereum and I take that and I put it into a DeFi protocol and it gets changed into, I take my Ethereum and I use it to put into the DeFi protocol for their token, and then I stake that token to a farm to earn returns. And then once I have my returns, I convert it back into Ethereum and have some income. What gets taxed there?
So just to generalize that question, we have many clients that enter into liquidity pools. Maybe they put Ethereum and DAI or whatever in, and they get an LP token back. And then later on, they put the LP token back in, get a pair back out. And so there are two schools of thought generally. One is that it's a taxable conversion when you receive that LP token. And then another taxable conversion when you exchange that LP token for the original pair. That is the conservative approach. It's the approach we go with. It's the approach most software also use as well. And that LP token is a new asset. It's a different asset. And that's a taxable event. That's one position. The alternative approach is that the LP token is not a new asset. It is what we refer to as like a claim ticket. It shows your ownership in the underlying assets or the underlying pair, but it is not a new asset in itself. And so you're entitled to, you still own, for instance, ETH and DAI was put in, you get your LP token, which is your claim ticket. You still own that ETH and DAI. And so as that ETH and DAI values increase, you then have income to you. And then when you give your LP token, your claim ticket back and get your ETH and DAI out, no taxable event. It was just you're getting what you have claimed to. But all the while, as your values are increasing, you have additional income. That's the second approach. From a practical perspective, from a technical perspective, it's actually nearly impossible to do because the decentralized exchanges aren't giving you the data to calculate. You know when you exit the change, but if we take the position that it's like an LP token, you are, I'm sorry, like a claim ticket, you are accruing value potentially every day. And we talked about staking rewards. Well, you got to pick up that income every day. So if we're going to use the second approach, and that's the legal argument, we got to be consistent in our application. And every day as that LP token, as that pair, the ETH and DAI increase in value, you got to be picking up income. That is practically impossible. The data is not there. What I just said may make no sense to most of you. It is very technical and things that we've debated at length within our firm. But I think the takeaways are that the general treatment of LP tokens is a taxable event. Could you make some sort of claim that it's, or an argument that it's not? You could. I would feel confident arguing it in tax court, but from a practical perspective, I don't know how to calculate.
Okay, fair enough. All right, well, thank you so much for joining us today. I think that's all we have time for, so we'll let you get back to your work. I know that it's tax season and you're very busy, but we always appreciate having you, and we'll be sharing this out to everyone who wasn't able to join us in person or online at this time. So I hope everyone's having a great day, a great weekend. Any final words?
Thank you very much.
Thanks, Andrew.